Now let's move to our forward proof. I believe the forward proof is probably a little more understandable from a conceptual standpoint. Let's get into cell B40, hit a 0, hit a 1, and then we're going to highlight those two and drag and drop down to 10, because it's a 10-year period. And what we're going to do here is we're going to start with these beginning balance, and we're going to build it up to the ending balance, which should be $1 million down the road. So our ending balance is the ending balance there. So for period 0, the ending balance is 0, just like period 0, and the backward proof is 0. Okay, and why don't we call this, we'll give this a name, end balance. In fact, why don't we call this P present value detail. Okay, so it's the present value from the detailed proof. And then I can, as you've learned before, since I've already used that formula, I can actually go to formulas, and under define name I can apply names, and I can apply this new name that I just wrote, and you see now it picks it up. This is kind of a slick thing. Now, as you know, the ending balance for period 0 is the beginning balance for period 1, so I'm going to hit equals F40. The payment, I'm going to put the payments in here as positive numbers, so I'm going to put a minus, and I'll pick up the pay. I start typing payment amount, and you can see it comes up, and I can double click that. The interest is going to be equal to the beginning balance times the annual interest rate, which is from up above, as you know. Now you should notice something here. There's no interest earned in period 1, and someone say, hey, wait, but you made this payment. Yes, you did make a payment, but that payment wasn't made until the end of the year. It was made like the stroke of midnight on December 31st, and therefore there's no interest earned during that whole year. That's what an ordinary annuity does. Now, if this were an annuity due, then we would have interest already in the first period based on this payment amount, because this payment would have been made at the beginning of the period. Now, the ending balance is going to be equal to the sum, actually. We can just sum these. We can just sum all these, and that would be our ending balance. And with that, we should have all the formulas that will work for us. So we can highlight that whole row and just double click, and as you can see, this cell, which is $1 million, is too wide now, so we can just drag and drop that. Now we're going to come up with our check figure. Now with this check figure, we're going to use the future value, because what we're saying is if I had 0 at the beginning of this period and made a payment of $62,745 as an annuity, as an ordinary annuity, what would the ending balance be? And that's what a future value does. So let's do that. Future value, and the future value is our annual interest rate from up above. You can go up and click, or you can just click it here. Number of periods, I'm just going to show you this. If I go up there, it's going to pick up the number of periods, or I could have just typed that in. The payment, in this case, we're going to pick up the payment here, and next is going to be our present value. The present value is the beginning balance, and the type is an ordinary annuity. Now, what was my mistake? If you look at that, what did I do wrong? I was trying to compute the future value after one period. Well, what did I do? I accidentally picked up the number of periods, which is all 10. So that says if I start with 0, what would the future value be 10 years from now? But I don't want to know about it 10 years from now. I want to only know it from 1 year from now. So all I did is I hit the F2 button, and I changed it from the 10 up here, the annual periods, to only 1. And I get to 6245.39. With that, I can then add the ending balance, and we reconcile and double click. So now we've got our check figures done, both forward and backwards, and we can highlight this and format it to be just a normal comma. Click the home ribbon under the number format, And so we've got that formatted.